Today is Monday, June 5th, and this is the ADM Investor Services Monday Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. Today's guests are Mike Niemiec, grain analyst here at ADMIS, and Alan Bush, the senior financial economist. Mike, here we are in the first week of June. How about an update on the U.S. weather? Any issues at this point?
We are starting to look at that a little bit more broadly now. We started a little bit last week with the oat and the spring wheat markets. We've seen a little bit of an uptick as far as looking at a drought monitor, seeing that there's a little bit of tenderness as far as moisture concerns go over there. But in general, the whole corn and bean belt is status quo right now. I think people want to kind of see the warm temperatures and the dryness that we're seeing right now. But obviously, if it extends even longer than this, that's not going to be warranted. So we are on step one. Adding to that, I also want to go and say it's a northern hemisphere growing season, so we're also keeping an eye on China and the Black Sea region and Europe, because those people have a little bit of an issue as well as far as needing a little bit more moisture. So there's a little bit of a weather concern as we start out this first week of June.
What about the wet areas in the eastern part of the growing region over the past few weeks? They had too much rain. There's a lot of standing water. Has that been cleared up as of now?
Well, this week is going to help out beneficially. It's the sense that there's going to be a very nice dry period, and I think this is exactly what they need as far as a remedy. And so once again, there's been no ignition to the marketplace at this point in time, haven't been wet, as opposed to now maybe calming down.
On Friday, we have another USDA report. What are the early expectations of that report, and what are your thoughts?
So we're going to have a USDA report coming out on Friday, and I think it's going to be pretty much status quo as what we've been seeing. We're still going to look at something of a non-bullish environment for the corn, wheat, and soybeans. Right now, we're looking at both old crop and new crop. We're transitioning off of the old crop, that being the July contracts, into the new crop. And what we're looking for is still somewhat of a bean carryout going forward. Now, once again, it gets back into the weather. So it's going to be a bean carryout that's going forward somewhere in the neighborhood in the U.S. of 400 to 500 million bushels, non-bullish. We're still looking at a corn carryout that's going to be 2.0 billion bushels, non-bullish. And we're also looking at a wheat carryout that's going to be 1 billion bushels, which is also non-bullish. So it goes back to weather going forward in here, since June is an important time period for it.
So Mike, sum up for our viewers what the grain markets look like at this time, and what type of opportunities should farmers and end users be looking for right now?
Well, unfortunately, there's not much of a story to tell other than the fact that it looks somewhat status quo and sideways. The important part, I guess, I want to go put forward in here is the commitment of trade report, which is not likely at this point in time, where the specs are sizable net shorts in the soft red winter wheat, in the in the corn market, and in the soybeans. So if there's any type of flare-up, that could be in a real explosive situation to see these folks want to cover. But it all has to do with weather. So what should farmers be doing? I think that what they should be doing is basically accept what you have right now. And the potential, however, is that if we do have a good growing season, in combination with the USDA report coming out forward, there could be another leg on to the downside, because right now nobody's biting to go and try and cover short positions.
Alan, U.S. dollar fell to a 7-month low on Friday, with the Fed Reserve on track to increase its Fed funds rate on June 14th and possibly one more time this year. Why is the greenback so weak?
Well, I think the problem is that the Fed is on a measured pace to raise rates. That seems to be a known. But what is changing is interest rates overseas are likely to become maybe a bit more restrictive in a sense that some of the central banks that had been accommodative and are still accommodative are likely to back away from that accommodation. That would include the European Central Bank and also the Bank of England, which possibly could raise interest rates in 2019. So it's interest rate differential expectations that are changing, and they're turning against the dollar index. Our feeling is that the dollar will probably continue to decline, while the euro currency will probably continue to advance.
Friday's employment report was a little weaker than expected, with May non-farm payrolls up only 138,000, which compares to an expected gain of about 182,000. Why did stock index futures advance to new historical highs on this bearish news?
I think the simple answer is that interest rates are still low enough to sustain a bull market for stock index futures, and not just domestically here, but internationally, as we did see some new record highs overseas as well, including the German DAX and the Korean stock index. So it's the interest rates that dominate, and they are likely to remain low for a very long period of time, even if the Fed raises rates in a couple of weeks, which they are very likely to do. So there's a lot left to the upside in stock index futures. Probably all this year, I think we can see continued strength.
Even if the Fed raises rates a few more times over the next couple of years, still historically, we're in a low interest rate environment.
Absolutely. These are still very, very low interest rates. And many analysts are becoming a bit bearish because the Fed has raised rates. The feeling is when the Fed is tightening credit that has to mean a top for the any bull market in indices. Well, not necessarily so, especially in this case, as you mentioned, rates are still low globally to sustain a bull market.
Now let's talk gold for a moment. The June gold futures advanced to a new 7-week high today. Can gold futures continue to advance?
Absolutely, and this is in conjunction with what we're talking about with the stock index futures. Rates are still very low, interest rates as low as they are, likely to prompt inflation, which we are seeing, and inflation is likely to accelerate. So with that in mind, there's a lot left to this bull market in gold futures. And I think we can take out within the next month or so the 1300 high in the August gold futures and continue to advance. So any breaks should be used as a buying opportunity, and I would say smaller breaks on the order of $8 to $10 breaks. Come in and buy gold. August is the lead month right now as far as volume and open interest. There's a lot left to this bull market in the gold market.
Thank you, guys. Remember, the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.